Hi, everybody. Good morning. It's Jeff Fitzpatrick. It is Monday, the 14th of April, 2025, and this is my weekly video log. Just to remind you, the strategy that I'm following is we sell puts and we buy high quality, great value stocks that increase our stock buying power. That then gives us an iterative process. We can go on to sell more puts and buy more high quality stocks. So as usual, I'm going to take a look at the market. I'm going to look at the stock pick situation, and I'm going to take a run around the clubs and see what's happening. First, the market. So we have two panels here. We've got that from a week ago in the top left, and then in the bottom right, we've got the position as it closed on Friday, the 11th of April. And we can see that the story is very different. We had two very good, strong up days at the end of last week, and things are now moving in the right direction. The trouble is with this is that it's not like there was bad economic news that we're just getting over. These falls are news-driven, political news-driven, really, on the tariffs. And the situation is such that we can have very, very big changes in direction based on often conflicting announcements by the Trump administration. So, and we're still well down. We're sort of 12%, 12.28% down from the peak. However, that's still better than it was a week ago. So the position is improving. For the next week or this week now, I'm still going to be concentrating on rolling put positions down to lower strike prices for future dates and getting extra credits for it. Most of the clubs are quite short of buying power anyway, and that's nothing that we've done. The brokers have simply reduced the amount of buying power that they want to be exposed to, but nothing that's going to kill us. The clubs then. So these are the puts that we have still outstanding. Two of them have been put already. The rest are still outstanding for the month of April. Unusually, expiration this month is on a Thursday, and it's Thursday of this week, Friday being Good Friday. So we've had a couple of stocks put to us. ST, which will take a little bit of work from Diamond. We're going to have to sell that stock, replace it with a new put, and we might have to do that 2 or even 3 times to get that back to profit. But I don't mind. Out of the whole portfolio, if we're doing it with that one, no problem. And with our Xerox XRS in Fortune, then we've had stock put there. It was only $9,000 worth. And it is going to, or has already diluted the price that we held XRX at anyway, which makes life much easier when it comes to turning it around. So I'm not too worried by that. Sapphire, no problems as we stand, due to just expire and leave us with the very nice premiums. Thank you very much. Teas are the same with Sprouts Farmers Market. And 100th millionaire, we've got one which is a bit close. That's Paramount. So I'll just be watching that. And it may well get rolled forward if it dips down, but otherwise we should be okay. Now, this is an interesting chart. So lots of information here. And these are either the total or the average of all of the clubs, depending on what the factor is that we're looking at. And the area that I'm most interested at the moment in showing you is at the very bottom 2 lines underneath the green shaded area. And that is the real value. The real value, the stocks that we own, the cash that we have, and the money that's in the pipeline from yet to expire premiums. On the 1st of July 2024, that came to 3,083,000 in round numbers. And at the end of July, it was 3 million, call it $900,000. So very significantly up. And that is the highest figure we've seen. So even though the tariff situation cut in and the fall began before the end of the month, at the end of the month, we were sitting very pretty with our highest ever real value. And still rolling along at 2.5% improvement per month. It has come down. It's been up there nearly 7% at one point. However, I'm sure we will get back there. We had a lot of legacy stocks to get rid of and things. I'm very confident that we'll move up from the not too shoddy 2.5% per month as it stands now. So I've been thinking a lot about the position on shares because we do get these pullbacks on average every 2 years and these major bear markets on average every 5 years. So we certainly were overdue, in fact, for a bear market, and they come for all sorts of different reasons. You don't just get Trump causes them, lots of things cause them. But you can be left every 2 years, every 5 years, holding a lot of stocks that reduce a lot in value, and then the things have got to sort of creep back up again. So the areas of our portfolio that are not affected like that are cash. If we hold cash, it doesn't go down in value particularly. Well, it might even measure against the pound at the moment, but within the account it doesn't. And also the future put income that we've got tied down in the pipeline. That we can actually just push forward and get more premiums for. So that's not a problem. The area of concern is the stocks that we own. And that's making me revisit the strategy that I think is the right one, which is rather than getting into a stock, buying it or acquiring it through a put sale and just staying in until forever, basically, I think it's better to get in, get out, get in, get out, get in, get out. That typically will give 70% more gain. But it also will crystallize some of the gains that we've got and put them into cash rather than have them held as shares. So I'm happy that I think that the current situation is confirming my thinking on that. So let's have a look. What have I got here? So I've got the clubs listed, and I've got the net liquid value as it stood at the end of March for each of them, and also the total. And I've got the left-in value. I now call it the real value, also at the end of March, and the totals, and the changes that we've experienced. So although the net liquid values have gone down from the beginning of March by 15%, and we usually do see a bigger percentage reduction or increase compared to the S&P 500. We've had like 15% on average, and no one's too far away from the average. Extra income is different. That's because we had just taken money out to pay some income. So some of that reduction there is about cash that we paid out rather than the reduction in value. If we look at the left-in value change, the average there is only 4.5%, and most are 6-7%. Again, with the extra income one is different because we've drawn cash out, but other than that, we've fared very well, I think. The S&P 500 fell by 5.56% in the same period, i.e. from the end of March, and it was also a further 7.6% from its peak back in March as well. So I don't think we've done too badly there. Now, what I'm looked at here is for each of the accounts, I've first of all looked at them. What proportions have they got of stock, cash, and pipeline income? And they vary. So you've got Diamond, for example, has 65% of its value in shares, 6.5% of its value in cash, and 29% of its value in the pipeline. And if we add together the cash and the pipeline, then there's 35%. And so we go down, Fortune 51, etc., etc., etc. Now, what I was expecting to find here was the higher the value of cash and pipeline income, the lower the reduction in value, left-in value we've had. But it was actually pretty random. It didn't actually work out like that. Here it is, in fact. So the left-in value, the lowest change was on the 100th millionaire, 3.46%. But in terms of the proportion of its account value in cash and pipeline income, it was actually third. And if you look at Sapphire, it was sixth, but it was only third in terms of value change. And so it's a quarterly income, not far off. It was sort of seventh, and ignoring the extra income, it was right at the bottom. So there's some relationship there, but it's not perfect. And I think that's because, again, we're still carrying too many poor stocks, legacy stocks that the old trading system got us into, which we've been busy creating value by selling new puts and haven't directed attention to getting rid of old stock. Still the right thing to do. The position is, what would we rather have? Would we rather have the account value maximized, or would we rather have all of the stocks that we have in the green, or in the black, as the parlance should put it, i.e. in profit? Well, of course, we want both, but I definitely think we want the account value maximizing, and then as a secondary objective to get the various stocks either into profit or off the table so we can use the money for something else. So this week's picks, no picks again this week. I'm still waiting for the market to settle. Who knows what's going to happen this week? But also, we've had a big reduction in the stock buying power. So trading is limited mostly to making additional premiums by rolling puts forward. There is a little bit of stock buying power around, so there might be one or two trades that do take place on new stocks. Facebook group, if you haven't joined it already, please do. It's the Extraordinary Stock Trading System. I put information in there. And if you're not already a member of one of these clubs, you can find out more at myinvestmentclub.co.uk, and you can get from there details about the clubs. You can also get to speak to the members, speak to me, find out more, satisfy yourself that it's something that's right for you. And if it is, come on board. You don't have to put a fortune in. You could put £100 a month in. You could put 100,000 in. You can generally put in whatever you wish. Well, that's about it for this week. So I'll keep managing things. I'm looking very carefully at the moment into the ranking systems for industries that are used by Value Line and the general market, and that should improve our trading a little bit more. Thanks all.